This morning's strong data. Our next guest does say markets are stabilizing. She does think a 50 basis point cut in September is still justifiable. Charles Schwab chief investment strategist Ann Sonders joins us this morning. Ann, great to see you. I know you heard what Steve just said about that pad in there. What does the argument for 50 sound like?
Well, first of all, it may be justifiable based on how real rates have gone up. I don't think the Fed is going to do that. And I think today's data reinforces that the Fed's bias, at least at this point, is probably 25 basis points. I think the jobs report will be the next key measure. The Fed hasn't put inflation data in the rearview mirror, but they clearly have elevated the focus on the other part of their mandate, which is the labor market. So I think that could be the next potential needle mover for expectations around Fed policy. It's probably not going to be PCE, because once you have CPI and PPI in the books, you can kind of map to what PCE is going to be, and it doesn't look like that will be an outlier. So I think the labor market will hold the key.
I'm looking at something JP Morgan wrote last night. Looking at the next jobs report, they say job gains in the range of about 160 to 200 would likely erase much of the fear invoked by the July print. Something in the low 100s, though, they say would put that risk balance back into growth and deliver a larger cut. Do those numbers make sense?
They do, but I think you have to go beyond the payroll numbers. I think the innards of the jobs report are at least as important as the headlines around payrolls. Obviously, the unemployment rate, long-term unemployment, what you see in terms of wages, hours worked, the differential between the payroll survey and the household survey, and not just the print on payrolls, but what the revisions are for the prior 2 months and any additional assessment about the benchmark revisions that are coming in the first quarter of next year. So I don't think you get anywhere near the full picture if you stop the analysis just at the payroll print.
You know, it's interesting because the Global Fund Manager Survey from Bank of America shows recession risk is the number one concern of these fund managers. Given the data that we're seeing this morning, are those concerns justified? We will get a recession at some point, but I think this cycle has been unique in the rolling nature of it, and that's something we've been talking about and writing about for a couple of years now. You had recessions in key segments of the economy concentrated in 2022, housing and manufacturing and housing related, and a lot of consumer-oriented goods. You recently saw a little bit of weakness in services, but that seems to have bounced. So I still think that that's the best way to think about this economy. That said, in terms of the launch point for the hiking cycle, and historically how many quarters it takes for that to bite and help to bring on a recession, interestingly, we're right at that point right now, 10 quarters ahead. So I don't think we're past the expiration date on things like the long and variable labs in terms of monetary policy, the weakness that we've already seen for quite some time in the leading indicators, the fact that the yield curve went from a pretty deep and long-term inversion back into positive territory. Those are historically recession triggers. You've got the SOM rule. There's a lot that's different in this cycle. That's why I think people are reticent to say, boy, it's coming, just because of the unique nature and the rolling nature of this cycle. But when corporations are telling you that they're concerned about risk, then a recession risk, and I think it's something you have to heed.
How about getting back to the market for a minute, Ann? You know, it's only a few weeks ago when we saw rates break down significantly. I think it was a CPI report, I forget. And then we had that great rotation that lasted all of, a couple of weeks, where everybody was talking about small caps. Is that not sustainable? And are we back to a mega cap-led market?
Well, I think there's some sustainability in the some broadening out and some money looking for opportunities down the cap spectrum. But what I think you need to do as an investor is you absolutely want to fade any of the lower quality components of what you're seeing move in an index like the Russell 2000 and lean into the higher quality. You still have about an 18 percentage point spread between the performance of the zombie companies versus the non-zombie companies within the Russell 2000, obviously in favor of the non-zombie companies. So I just think it's really dangerous to think about small caps in any kind of monolithic way. There's a huge spread up and down the quality spectrum within an index like that. And there are times where moving down the quality spectrum makes sense if you've got, that's where the leverage is to a major upturn in the economy. That often happens coming out of a recession. I just don't think we're at that point in the cycle. So the opportunities may exist, but you absolutely want to stay up in quality, profitability, high interest coverage, strong balance sheet, strong free cash flow. That's the way I would approach any continued rotation.